In this recording, I will briefly review cash planning or cash budgets. Cash budget or cash forecast is a statement of the firm's planned inflows and outflows of cash. It's a very important tool to manage solvency and to make payments on time and to plan for funding needs and surpluses, which can be placed in a bank or in short-term securities. This is a very useful tool where a lot of CFOs and even CEOs continuously track. It is used to estimate short-term cash requirements with particular attention to anticipated cash surpluses and shortfalls. When we have surpluses, those surpluses must be invested, and when we project deficits, those deficits must be funded. The cash budget is a real useful tool for determining the timing of cash inflows and outflows during a given period. Typically, monthly budgets are developed covering a 1-year time period, but cash budgets are prepared with various frequencies. A lot of companies do have a daily cash budget. They track very carefully. They do have weekly cash budgets and also monthly cash budgets. In our examples, we're going to review monthly cash budgets, which is quite common for a lot of firms. Like a lot of other forecasting tools, a cash budget begins with a sales forecast, which is simply a prediction of the sales activity during a given period. A prerequisite to the sales forecast is a forecast for the economy, the industry, the company, other external and internal factors that might influence company sales. So these sales forecasts could be top-down, bottom-up. It might involve different teams in the company so that these projections are made with some accuracy. The sales forecast is then used as a basis for estimating the monthly cash inflows that will result from projected sales and outflows related to production, overhead, and other expenses. This is a general format for cash budgets. This is obviously not the only way that a cash budget can be constructed, but this is a very standard format. As you see in here, on the top we do have cash receipts. Right at the bottom we have, or below, we have cash disbursements. So receipts minus disbursements will give us the net cash flow for a given month, day, or week. We start the period with some cash on hand. We call this beginning cash. When we incorporate the net cash flow for the period, we get ending cash flow. A lot of companies operate with a minimum cash balance, so we subtract the minimum cash balance from the ending cash. If there is a surplus, that means that we have excess cash balance, which needs to be placed in a bank account or maybe invested in a treasury, a repo, or some form of interest-earning instrument. In contrast, when we do have a shortage, that is when the ending cash balance minus the minimum cash balance turns out to be a negative figure, then we have a required financing. We should plan for some type of credit line or some bank arrangement that will allow us just to procure this needed financing. So as you see in here, from one period to another one, ending cash turns out to be the beginning cash the following period. And then we incorporate the net cash flow, find out the ending cash. figure out the minimum cash balance and whether we do have a surplus or deficit, and we plan action based on this. Remember that this statement is prepared for the period ahead, and for every period we have a visibility regarding fund surpluses and fund needs. We will illustrate cash budgeting in the context of a simple example. Let's look at this example. Coulson Industries, a defense contractor, is developing a cash budget for October, November, and December, next 3 months ahead. The company's sales in August and September, preceding 2 months, were 100,000 and 200,000 respectively. The projected sales for October, November, and December are 400,000, 300,000, 200,000 respectively. And we have further details. Regarding company's collection policy, we have some information. Historically, 20% of the firm's sales have been for cash, 50% have been collected after a month, and the remaining 30% after 2 months. So in December, Coulson will also receive a $30,000 dividend from a stock in a subsidiary. So they do have an investment in a subsidiary, and they expect to receive a $30,000 dividend from their company. So based on the information that we have, we could project the cash flows for October, November, and December. However, as we described in here, we have 2 months lag for collections. Therefore, sales that were made in August and September are also pertinent to determine the amount of cash that is available in October. So, for instance, $100,000 of sales were executed in August, but only $20,000 of that was collected in August. 50% will be collected in September. It's in the past, so this is the amount that has been collected in September. But still, we do have 30% that is still yet to be collected in October. So $100,000 of sales, $20,000 has been collected in August, $50,000 will be collected or has been collected in September, and in October we do have a $30,000 that is going to be collected, still from sales that were generated in August. So September sales were $200,000. 20% of it was collected in September as cash. 50% of it is going to be collected in October, right in here. And 30% of that is going to be collected in November, 2 months lagged cash flow in here. So in October, we expect $400,000 of sales. 20%, 80% is going, 80,000 is going to be collected in October. 50%, 200,000 is going to be collected in November, and then 30%, which is 120,000, is going to be collected 2 months later in December. Similarly, $300,000 of sales generated in November is going to bring cash $60,000 in November, but 50% of it is going to be collected in December. And of course, this also goes into January, because $90,000 is going to be collected in January, but we are not planning for January yet. So this is only for the October, November, and December period. So based on this data, our October total cash receipts are going to be $210,000. And in November we will have a total of $320,000, and in December we will have a total of $340,000. Company's cash disbursements are described as follows. The company purchases represent 70% of the company's sales. So, for instance, in August, the company generated $100,000 of sales. 70% of the $70,000 represent the purchases that the company has in August. 10% of this will be paid immediately in cash. So, in August, for instance, $7 million of cash payment is going to be made. And then 49,000, which is 70% is going to be paid in the following month. And then remaining 20%, 14,000, is going to be paid in 2 months following the purchase. So the firm also has expenditures on cash, or expenditures on rent, wages, salaries, taxes. There are some capital asset investments, interest payments, dividends, and a portion of the principal on its loans. So we're going to detail all of these in a minute. So here are the descriptions of those payments. Rent payments are $5 million each in October, November, December. Wages and salaries are $48, $38, and $28 million following months. Tax payment, in December we will have a $25 million tax payment. We plan an outlay, a capex of $130,000 in November. A scheduled dividend payment in October, $20,000, and in December there's going to be a principal payment of $20,000. So these are some of the disbursements that we have, excluding the purchases. So if we go through the calculations, in August, as we said, 70% of the sales, which is 70,000. Of purchases were made. 7 million was paid, 10% of it in August. 70% of the purchases are going to be paid in September, and 20% is going to be paid out in October. So 70%, 1 month lag, 70%, and then 2 months lag, 20% is going to be made in October. In September, the company's projected sales were 200,000. 70% of 200,000 is 140. 10% has been paid out in September. Still, we have 70%, which is $98,000, to be paid out in October. And then 20% is going to be paid out, which is $28,000 in November. So based on all of this data, we have disbursements that are going to be $213,000 in October, including rent, wages, salaries, and so on. So $230,000 are the net disbursements that will take place in August. $418,000 in November, and $305,000 in December. So when we combine purchases and other overhead and expenses, these are our disbursements for October, November, and December respectively. So now we will put this together in our cash budget, structured cash budget table. But we have also an additional information here. We have to start with $50,000 in cash, and no money in notes payables. That is, there is nothing in the bank account, and we would like to operate with $25,000 of cash. So minimum cash requirement is $25,000. Beginning cash is $50,000. So these are sort of plug-in numbers or assumptions. Obviously, when we start the period, we will assume a certain amount, and this can be debated. But in this particular case, $50,000. Again, minimum cash balance is the firm dependent or business dependent. In this particular case, company feels comfortable with $25,000 or minimum cash. So if we look at the October, November, and December, total receipts we calculate as $210,000. Total disbursements for October, $213,000, which leaves a net minus $3,000 of net cash flows. Beginning cash was $50,000. This means that ending cash is $47,000. We have a minimum cash requirement of $25,000. This leaves an extra $22,000. So we do have excess funds for October. That means that this $22,000 should be placed either in a bank account that earns interest or placed in a marketable security like treasury bill or maybe a commercial paper, something that earns interest during that period of time. Now, when we start November, we expect $320,000 total receipts and $418,000 of total disbursements. Net cash flows for this month is going to be minus $98,000. If you remember, we said the ending cash balance for October will become our beginning cash balance in November. This makes the assumption that $22,000 that was placed in October have been liquidated and now converted into cash, and it is available now. So we do have $47,000, including this $22,000 that was placed for a month. Now, with $98,000 of negative cash flow, we have a minus $51,000 of ending cash. Since we also need to maintain a $25,000 of minimum cash, this means that this month in November we will need $76,000 of financing to sustain our operations, to be able to maintain a $25,000 minimum cash requirement. So that would require us just to borrow $76,000 or maybe arrange a credit line so that we can borrow $76,000 in November. So we know that we do have a cash shortage in November, and we will be prepared to procure that amount. Now, for December, since the ending cash balance in November was minus 51, which also includes or assumes that this bank balance has been paid out. So the ending cash balance brings us to beginning of minus 51 for this period. We have a $35,000 of surplus in here. That means that we still have a $16,000 of cash deficit plus $25,000 of the minimum cash requirement that we do have. This means that we do still have a $41,000 of financing for December. So if you take a look at these 2 months consecutively, we had a bank loan of $76,000 in November. In December, that bank loan declined to $41,000 because the $35,000 of surplus that we had would help us reduce our bank balance to $41,000. So we will have a $41,000 of notes payable in our balance sheet as of December 1. This means that a credit line of maybe $80,000 will will take care of our cash needs during this 3-month period. If we arrange a sort of revolving line of credit, we will be able to pay back the amount that we do not use. For instance, we peak in November with $76,000, and then we pay off some of it because we do have some extra cash that comes in here, and our bank balance declines to $41,000. So when we look at this next 3-month period, we will be prepared for these outcomes. We will need to make arrangements to place the $22,000 of surplus that we have, and then we will have to make arrangements to procure the $76,000 and $41,000 that we would need for November and December. So essentially, the cash budget gives us some visibility about the future, tells us about our surpluses and deficits, and prepare us for these outcomes, so that we are not caught unprepared for these shortages that we encounter. Now, like any type of budgeting exercise, these are all based on assumptions. It is possible that our cash receipts might be a lot less, or cash disbursement might be a lot more. So it is always prudent to engage in some type of scenario planning, where we could assume good, normal, and bad outcomes, so that we can be prepared for the worst case, rather than just sticking to these point estimates that we made in the planning process. So something like the following, for instance, would be quite useful. So we could assume the pessimistic, most likely, and optimistic scenarios for each month. For instance, in this assessment, our funding needs might be as large as $190,000 under pessimistic scenarios, and we might have as large as $107,000 for placement. So in either case, we should be prepared for these extreme outcomes, and we need to negotiate the credit lines accordingly. So just to summarize, cash budgets indicate the cash shortages or surpluses in the months that are covered by the forecast. And in our simple example, we found out that we will maintain a $25,000 of cash balance during these 3 months. In October, we will have $22,000 in marketable securities, because this surplus that we have is going to be placed. But in November, we will have a notes payables of $76,000. In December, that is going to decline to $41,000 because of the surplus cash that we receive. We will pay off some of the bank debt that we have, and that will bring our balance to $41,000. So that will allow us just to plan for these possible outcomes, and we will avoid insolvency by engaging in a cash budgeting exercise. So this is pretty much about it. I would recommend you just to work on the Keith company cash budgeting example that is posted under the financial planning session. That would just solidify your understanding, and you will have an opportunity to practice a cash budgeting exercise.